Greetings, everybody. This is Jeff Scott, and welcome to this week's edition of my top-down review. It is February 7th, 2021. My email address is hgsidoc@gmail.com. If you're watching this on YouTube, please subscribe. Doesn't cost anything. I won't get your address, but if you click on alerts or you're allowing alerts every time I post something, you'll get notification. If you like this, do the thumbs up. If you don't, do the thumbs down. And I do appreciate comments, whether it's via email or on the YouTube site. Also, if you're watching it on YouTube and it's blurry, it's because you're getting this too early. When I load it, it's in 4K. The initial upload is horrible. It's like 480p. But if you wait a while, it will turn into 4K. Somewhere down below where it says remarks or comments, you'll see a link for a 4K if you want to download it. On that note, let's go ahead and get started. I titled today, Market Breakout Leads to $1 Million Portfolio Gain in 1 week. Last week at this time, I was concerned that we were potentially breaking down. I showed the top middle of the week, but I also commented that I shouldn't forget that despite my concerns, we were still in an uptrend. And boy, did we resume that uptrend this week. As always, this is for education purposes only. Any recommendations are in the spirit of education should not be considered investment advice. I am a doctor, not a broker. I am independent. I paid for the tools that I use. And trading involves risk, and you and you are solely responsible for any investment decisions you make. I may talk about options today on one trade. If I do, I will call out that the powers that be consider options to be even more risky, and I would refer you to the Options Industry Council. They have some excellent downloadable files, PDFs, that can review with you the reason why the risks are so much higher. I have my own style of trading. I call it be your own guru. I'm not a guru. But what I have is I've learned from many gurus out there, some of which are here, also are some authors and software providers. And it has created my own style. And if someone asks me what is my favorite style of trading, it's top-down trading. So market means everything. Buy the stocks that are leading in the best industry groups. And I like to buy those stocks when they pull back to support and break out. So that's what I am. I guess I should call myself a pullback trader, but I think the top-down part is super important. I own a lot of programs. If you came to see my office and my house during the day, TradeStation and Thinkorswim will be on my computers. I use indicator sets, many of them, but especially from John Person, Dr. K, and Sagar with Q Tools. You'll see the Q Edge up running in one of my monitors all day long as well. I have introduced some of my followers to these folks over the years. When you buy something from them, I don't take a fee. I don't get a percentage. It's between you and them, and I always ask them to give you a bigger discount because unlike other affiliates or people who might introduce somebody to their audience, I have no interest in being paid. And so thus, I am only an unpaid volunteer, and this is what it is, which is free education. Website for HGSI, again, no affiliation except I'm a user, and I do provide free support from time to time to folks who have challenges using the program. Up here, free 30-day trial. Under investing strategies are, I hate to say, hundreds of videos by Ron Brown and myself and others. Where are we in this market? Last week I talked about how we keep going up to this sideways period, and then it feels like we're going to roll over, and it did Friday a week ago, and then bang, we take another run up. We are not March 23rd, 2020, sitting here and not believing we're going up, but breaking out to a long uptrend. That's not where we're at today. Friday, I wondered a week ago, were we about to roll over into the abyss? But lo and behold, news flow, earnings, etc., and we went off to new highs. So you got to trade the market we got, and right now the market we have is going higher. Because of that, I bought stocks and calls, and I reduced my protection. Now, to be fair, at about 3:45 Eastern time on Friday, I added some contras back, some cheap options on them just in case the market had something happen over the week. And we do have issues around the stimulus circling. COVID has not gone away, but to counter that, we've got a J&J vaccine that might get approved in the next week or so, maybe even sooner. When I look at the markets, I like to take a picture of the sectors, and starting where the arrowhead is, we have the various S&P spider sectors and the various stocks in them. I added some in the real estate, and you could see, even though the indexes were all green and all very bullish, led by the Russell and the mid caps, it was a mixed day on Wall Street where there are clearly more winners than losers, but there's still a lot of red here. I like to look at the major markets because I think they tell a story, and let's take a look at what we have. We have the daily chart here, and let's go ahead and let's maximize the sell. So this should be a year's worth of the S&P futures and a couple of different things. We knocked off the 138% retracement here on Friday. That had been resistance. So this, we took out what had, as you can see over here, had been an area where the market continued to struggle. Now let me just check one thing. I don't love the drawing on Thinkorswim, and it's probably just because I haven't spent enough time. But can I connect this? So we are right up against resistance, a trend line connecting the prior high and then the high back in February. So this could be an impressive breakout. We'll see what it does this week. As I said, you got to play the market you have, and that market is bullish. How can it not be when you closed at an all-time high? On Tuesday, you had a new John Person buy signal. You could see the prior Friday closed just below the 50-day moving average. And on Monday, it opened, traded below, and then traded up the rest of the day. A very bullish day. Every day green on the week. Very bullish looking. The only question is, how far can this thing go? If I look at the NASDAQ futures, I could say ditto. The only difference, well, it did set an all-time high on Friday. Person buy signal came in on Tuesday. Beautiful story here. And I guess it closed above the prior high, so NASDAQ looks great. Dow futures, let me make that the same duration, has not taken out the prior high of 2 weeks ago or so, 2-3 weeks ago, does have a buy signal and did break out as well. It was a bit of a laggard on the week, well, at least on Friday. And if I look at the Russell futures, there's no laggard here. Wow, just look what this thing has done ever since the March 23rd low. But won't it be nice in a couple of weeks? We'll have lapped that. Should set for some pretty good same-store sales growth and earnings comparison as we start to go through some of the worst COVID shutdown comps. But breakout, new high, new closing high, closing near the high, new person buy signal. The Russell futures, at least to me, look very strong. The VIX traded down this week, and that's great if you are bullish. What isn't great necessarily is it's still elevated compared to where it was prior to last February. Now, sometimes I'll look at the VVIX, the volatility of the VIX, and it may precede the VIX going up, but even the volatility of the VIX is really at a good place. So volatility definitely down. Does that mean it's time for it to bounce? It could be, but we certainly could break down to the prior levels. The dollar, which had been strong, had a weak bar on Friday. We've been talking about the dollar and could it get above the 17 and the 50, and it's done it. Still in a downtrend, pretty significant downtrend. and it did have a reversal bar on Friday. We'll see which way it goes. If I was to flip this out for the weeklies just very quickly, just to point out the all-time highs on the weekly, E-minis, NASDAQ, just off the all-time high on the weekly, on the Dow, all-time high on the Russell. What a strong, strong, strong. And then we look at the VIX here, the reversal, and although you had a new person buy signal on the dollar on the week, the dollar's got a topping tail. So it'll be interesting to see what happens with the dollar. If I had to bet, I would bet the markets at least start the week by going higher, but all of that is subjected to news that occurs over the weekend. All right. Let's look at some of the things underneath that might be driving this market. Banks were strong. Why? Because rates are rocketing higher. Now, there'll come a point in time, and drawn right here, for example, where when you get above a certain amount, that's actually good for the market, because these low rates here, it's because of the economy sucking. And you can get to a point where some more rising rates would still be greeted by the markets because they're still historically low, and it might signify improvement. But you can also get to the point when you start breaking above this line where it starts to impede the market in yellow. So right now we're in sort of a happy place with rates, rising rates in the setting of very low rates, perhaps suggesting improvement in economy, and maybe some inflation is around the corner, while the Fed has said they're not raising. AD lines, again, how can I be bearish when AD lines and the indexes are at all-time highs? On the left are the Russell 2000, on the right, the Russell 1000. So the small mids on the left and the large caps. I have their specific AD lines in yellow or white, I can't tell, and then the orange and red are their specific ETFs. If you want to look at the NYSE, what a happy picture here. All-time high on the NYSE AD line. Each of the ETFs up here representing the major market indexes are up. And the only thing that's dropping are the bonds, as money continues to be flowing into stocks. Now, at some point, if we did have a substantial crash or correction in bonds, that might impede the market, but right now that looks pretty darn good. What about breadth? Now, breadth is starting to get scary. If you go back a couple of weeks, it does feel like we have 1 week up, 1 week down going on. But if we go back a couple of weeks, we were starting to see the breadth start to ease off after it had run up pretty far. Well, in 1 week's time, the stocks above the 200 and the stocks above the 40 almost regained their recent highs. And we are at levels where we haven't seen them for years, especially on stocks above the 200. So when you start seeing more overbought than you've seen over the last 3 or 4 years, probably tells you there's a limit to how far this can go. If I look at stocks on the T2121 and Ward in the 12-week new high, new low, or 13-week, we rocketed right back up. And historically, when we get at this line, we typically will either go sideways or pull back. So there could be some, it doesn't mean massive correction or February 2020 type of a correction, but to get a mild correction sometime in the next week or two would certainly be okay. And frankly, a sideways move to let some air out of the balloon wouldn't be so bad either. Look at the McClellan, new highs on the McClellan oscillator, of course, on the S&P. We haven't taken out the highs, and so you could say perhaps there's some bearish divergence here with the oscillator and the summation index, but certainly the oscillator had a big move this week, and on the weekly we crossed above the midline on the oscillator, but clearly on the summation index, not so much. The buckets tell me an interesting story. On the lower left, we see the buckets from last Friday, and I did comment that we were oversold with 14+% of the stocks in the S&P 1500 trading below their lower Bollinger Band, I said that we could get more oversold, and typically we do, but we didn't. And you can see where last week 75% of the stocks in S&P 1500 were trading below their midline of their Bollinger Bands. Now it's flipped to 69% above. Clearly a bullish reading. 10% of the stocks above their Bollinger Band, not excessive. So I've gone from bearish to bullish on the buckets. Sager added in the Q Edge tool so I can look at it today and yesterday in a real-time basis, which gives me added information of what's going on with the market internals. The Hindenburg Omen is one of my favorite signals, as taught to me by Ian Woodward. There has been a major market correction since the Depression without the Hindenburg Omen signaling, and there is no signal. What that tells me is we're unlikely to see a major setback here. It doesn't tell me we can't see a 2, 3, 4, 5% correction, which modest correction, which probably at some point the market will almost need. If we look at the market tone and we look at the Woody indicator, the multiple indexes, all green with one yellow, so certainly an improvement over the last week. If I look at market performance, on the left is the Edge Rater Warehouse report. So to run this, I took fundamentals from last Friday, and then I asked the question from the close of Friday to the close of this Friday, how did the market do? In the middle here, we have EPS rank, relative strength rate, and group rank. ERG 0 to 99, add them up, the most you get is 297. So this told me that the market as a whole did well because the average was above 8%, but there was better improvement with better earnings, better improvement with better relative strength. The stocks that were accumulating the week before actually underperformed compared to C, stocks that were in the middle of accumulation distribution. But most importantly, this was a week where high org mattered, and that's good because that reflects how I trade. I always take out the bottom three and the top three because there's so few stocks there. But if we look at the middle of this, between 5 and 12, 13%, the higher number for the higher ERG. So I know it's a great week for growth. If I look at the group performance analysis in HGSI, running Friday to Friday, using the same fundamentals and the groups that I picked a week ago, you can see the date on those a week ago Friday. What do I see? I see that the S&P had a great week. I mean, how's it not a great week when the S&P 500 is up 4.77%? So if you lost money this past week, you're buying too much GameStop and other story stocks, and you're not buying good quality products. Or you had a couple of bad earnings reports. If I look at the Investors Business Daily, up 6.5%, Marcus Smith up 7.09, Weekend Review up 9.38. You could see how strong growth was. And my stocks that I went into the week with were up 80 wins, 10 losses, 7.2% return. Now, since I do options and I use margin, that could have reflected a closer to 20 or 30% return, and it did on the week. Very few groups down here in red actually underperformed. A couple of groups that you may not know, Mike Scott, I think he actually knew Ian, and he does this spreadsheet that is posted on various boards I go to. And that spreadsheet has some pretty good stock selection criteria. And for example, this week he had 86 to 11 wins versus losses in his Focus 3, which is his curated list, average up 10.8%. How do you beat that? Woodward & Brown growth stocks up 9.4. This was a week for growth. The Canaries up 7.69, 8 out of 8 up. Strong week. I hope you made money. Sector strength, except for, I can't even read it. I think that's oil. Sectors were predominantly green, which is bullish. If we look here in the Q Edge tool, we can see on Friday, all sectors were up over the 2 days, over 5 days for the week. All sectors closed up. The vast majorities of industries were up, a little bit less, 20% down versus 80. where there was 95% up on the week as a whole. And if you look at one day, a third of the stocks were down. So I said, even though there was a lot of green, it was weaker than maybe it looked, which was more down than they were on 2-day look or a 5-day look. If we look at what was winning on Friday, discretionary and communication services, up at the top, you can see various time frames, and you can see that consumer discretion has been on fire even when you look back over a year, the number one group. Communication services was up high, had spiked its toes and is back. And what's lagging, interestingly, financials and real estate and energy had a tough day on Friday, perhaps related to the employment numbers and concerns about economic growth. Here are the various sectors. Now, the beauty of the Edge tool is that once the market opens on Monday, we'll start populating the real-time tool. And we'll be able to understand real-time what sectors are leading and drill down to which stocks are leading. And we'll open up another set of pies, which will be real-time, which will reflect the action on Monday. Canaries, someday I'll change price line of booking. I did it in the chart. Ian put together a list of what he called canaries in the coal mine because they represented some of the leaders in the market. And he felt that they would give us an early warning signal, perhaps if the market was falling. They've had a great year. They've had a great several years, but they are trading just below all-time highs. So after a big sell-off, this is where we were sitting last week on Friday, where I can understand why I was nervous looking at this. We almost had an equal and opposite starting the week, and now we're above where we were on Thursday and approaching all-time highs. Another strong week of earnings. I listed some here. This is just an email I get from MarketSmith. It is not all inclusive, but I find that it includes a lot of the stocks that I look at and that I buy. Next week, this is from Market Watch, a list of the news, nothing on Monday, small business and job openings on Tuesday, CPI inventories on Wednesday, budget, my God, deficit. Thursday, jobless claims, Friday, sentiment, medium at best. I think the biggest news may come out of Congress and what they do with the stimulus. So we reversed off of support, set new all-time highs. Last week's pullback was followed by a widespread breakout this week. You can see how we did on Friday. A lot of this growth, or this performance, is driven by earnings growth from recent earnings. And you could see that the Russell's leading the pack, up 13%, the NASDAQ 7.5%. And after a powerful week, everybody turned positive. I think we're going to still have news going forward. And personally, I'm looking forward to the J&J vaccine, which is one and done dose, easier to store. And although its top line performance numbers look inferior to the Pfizer and the Moderna trial, the fact that it was used in parts of the world that have more aggressive strains and had reduced dramatically hospitalizations and eliminated death, it may actually be a pretty good story. So I know it was originally planned, I think, to be used in third world because it's cheaper and again the single dose, but I suspect we'll have that coming to a grocery store or drugstore near you soon. I had my best week probably ever last week. As I said, I almost immediately covered my protection, added to my longs. A couple of my biggest positions were Apps, SE, Penn, and Magnite. Apps and Penn had monster earnings. SE just continues to be a monster. And Magnite had an okay week, and then on Friday they announced the acquisition. And this was a case where the company buying MGNI actually went up a ton. So I'm now up in my trading portfolio 47%, about 1 million gains this week. I started the portfolio with 3.1 million. I've taken out 600 or 700 million, 700,000. I bought a third house. I'm just crazy. Another house down here in Florida. So I'll be draining that. I've got some taxes to pay and a few other things. But it's all good, and hopefully we'll see further gains as the stimulus package makes its way and we get J&J's approval. Now, things are not perfectly rosy. Cases are high, hospitalizations are high, and the weekly unemployment reports reminded us, actually the monthly unemployment report on Friday, reminded us that the economy is still fragile at best. But I'll trade the market we have, continue to be nimble, and we'll make change based upon current and subsequent future market changes. All right, so I have a tendency to show you my performance, to put my money where my mouth is. I keep saying I'm not going to do this anymore. I think it's important because there's a lot of people who want to sell you stuff and you'll never see their P&L. And frankly, I always wonder why, if people are great traders, they have to spend their time teaching other people how to trade or selling them indicators. But here you can see my overall P&L as of February 5th, plus 1.451 and change, so 1452. As I said, I started with 3.1. I've got 3,940 because I've taken $600,000 or $700,000 out. I continue to take things out as we go. And yes, if you've never been here before, you're probably looking at this screen and saying, I can't read it, it's too small. Sorry about that. I can't read it, and that's what matters. The other thing you're saying is, how many positions does this guy own? I have a lot of positions. I have 2 accounts represented here, and you'll notice that my biggest performer, SE, is not even in this account. And there's some stocks that are in both accounts, APPS, the MGNI, Penn. What a monster this week. I manage a lot of positions. Now, I'll tell you that I have some zombies in here. Now, in bad markets, a zombie would be a call that I bought for $2 and it's now worth a nickel. So who cares what the stock does? I can't get any worse. But in a bull market, sometimes I don't know if I mentioned today, I buy calls for the most part. Calls are cheaper than buying stock. I can control a huge amount of calls at one time. I sell calls against my calls, which reduces the cost of my trade. So if the market drops, my actual loss will be mitigated a small amount by my short call, okay? Sometimes I may have a 35, 45, 10 wide call that I paid $2. So if it trades above 45 at the time I close it or at expiration, I'll take back 10 minus the 2 I paid for it, and I'll live all day getting $8 for every $2 I put in. That's a pretty good return. If you do that month in, month out, you don't have to have a day job. The problem is if the stock goes to 45 or 50, I am, if I had a 30 to 40 call spread, I still get my $10 minus the 2 I paid for it, but I don't participate in the movement. So I've got, for example, I've got multiple plug positions. One was a 35, 45 call spread. Well, if I bought it for $2 and I get $10 for it because it's in the 60s now, I got paid 10 minus 2. I made $8 on a $2 investment. Great return. That's why you see things here. You probably can't see it, but it says 724% return. Well, that's on Riot. Never mind. The plug is 167 here, and then a little bit on the other one. The reality is I'm okay with that, but that becomes a zombie spread. If that spread is so far in the money that even on a 5 or 10% correction, it's not going to get there, who cares about it? I try and sell it for close to the $10, but I'll wait to expiration. So I've got a bunch of those zombies where I've been left behind, but a very profitable position. I should do a presentation, maybe I'll do a live meeting about how I enter positions, what options I take, and why, because I think I have a unique approach. Whether that's good or bad, you can tell me. Do I make money? You don't have to tell me, I know that answer. Now, one thing I like to do, I do the same thing every week, is just try to get an understanding of what the market's doing. So in TradeStation, I look at 6 or 7 points. First thing I look at, am I in a buy signal or a sell signal? And the beauty of this is we flip to a buy in TradeStation, daily, weekly, and monthly. Is my paint bar green, which is bullish? It's a Alexander Elder indicator. When it's green, I could be buying or holding. I should not be shorting. I got green, blue, green, so that's bullish. I'm within the envelope, and we can certainly write up the envelope for a long time. That's okay. I do have a red dot here. What does that tell me? That tells me, and it's interesting, that even though we know that's an all-time closing high, so it's a higher high, we haven't been able to flip the MACD to positive. So that's a concern, that we've got some MACD divergence on the daily, and we've been living with it for a while on the weekly. But that said, it always resolves in a pullback, but it can go a long time before that happens. Dropping down here, the weekly bongo turned to green. That's awesome. My Laguerre RSI has not flipped to a buy. I can live with it. And my high jumps at 77%, which is okay. So the E-mini looks very bullish. If I look at the Dow futures, I got a buy. The Laguerre RSI went positive. I'm green everywhere. I'm right in the middle of the envelope. My weekly bongo is green. My high jump's at 58. Dow looks just fine. If I look at the Russell futures, up at the top of the envelope in a red dot, but it's in a buy. It's green. Getting a little bit extended. It looks like a 91% on the high jump. So the Russell, which has been the leader, is still not at 95 or above, but it's getting close to an extended range. And then lastly, the NASDAQ futures, which also near the top of the channel, but in a buy in green with a MACD divergence 85 on the high jump. If I want to see something that doesn't look good, well, the dollar will look okay. The dollar turned blue here. Notice that you get the green dots after a prolonged pullback here on the weekly, which show that lower low on the stock price, but a higher low on the MACD. Again, a divergence that could suggest, or in this case, a convergence, a positive divergence, that could suggest that a reversal was happening, and it did. Let's go into HGSI. Now, this seems like a lot of stuff that I'm doing. And people look at my returns and they sort of I get a lot of comments that I make it look so easy. I look at a lot of charts. I've been doing this for a long time, but I've looked so far today at probably 1,400 charts, 1,500 charts between HGSI and TradeStation. And the weekend's just the middle of Saturday, just going into Sunday. So I'll probably look at some more before we're done. And then the other thing that's been remarkable this year for me, and I'm sure for others as well, I'm not used to being home. So I've never performed as I've had since COVID started. Now, either I'm a better trader or I'm just not used to being able to pay attention like I do. But whatever, I'll take the better returns. So we look at the strength of the market. So I want to go top down, T1, excellent. I want to make sure I'm ranking by raw combo, which I am. The leadership was the mid caps, the Russell, the small caps, the ARK funds, FANG, and the NASDAQ, and then the IBD 50s. You know, if you're a growth stock investor, you didn't make just some money this week. You should have made a ton of money. And I'm sure you did. And if you follow some of my picks, you made a lot of money. But I don't do this for that. I do this for learning. And let's see. All right. I hate to do this. It may screw up the whole video, but I'm going to try and increase the font a little bit. Nope, I'm not going to do that. I just noticed it changed my whole screen. All right, not going to happen. I have to do that before I start the video. I could have made everything a little bit easier for you to see, so my apologies for that. I'm going to set my charts up. So the S&P 500 was, even though it was positive on the week, a lot, 4.8%, it was number 26 on the list of strength. It just tells you how incredibly strong the market was. And yes, I've looked at this before, but maybe I didn't say it in the beginning. I make this kind of money because, the word thematic investing is a big deal right now. The ARK funds with Kathy Wood are thematic funds, the ETFs. I'm thematic too. I'm a top-down investor, which means the first thing that I pay attention to, and I pay a lot of attention to, is the market. The second thing I want to do is find the best stocks in the best industry groups. So I have to look at the industry groups. So I think half the return on Monday is going to be if the market's up or down. That will be the direction. Probably 20 to 30% is going to be if I'm in the right industry groups. And then the last 20% is going to be the stock I pick. So I'm going to spend all this time today and look at the markets, the industry groups, and then the stocks last. Because I could be the world's greatest stock picker, and if the market begins its correction on Monday, my stock's going down anyway. So very quickly, in HGSI, the reason why it's a pseudo S&P 500 is that HGSI stopped purchasing the CBOE indexes. They've made them ridiculously priced, and they would have to raise the cost for everybody. So instead, they calculate it from the SPY, and hence we call it the pseudo S&P 500. If we look here, here's that retracement line, and you could see we finally broke above it on Friday. Now in the cash markets, it's actually a red candle, which means it's kind of a doji, but it means it came off the highs of the day. And if we look at it, you could see on the day before we had a mobile breakout from a squeeze, and we had two kahunas on Monday and Tuesday. Weekly bongo turned green, very bullish appearing. Weekly looks great, all-time highs. How can you not want to be long here? I mean, obviously, we are getting close to the high jump bar. We've had a huge run, but you got to trade the market you have, and the market still looks like it wants to go higher. Talk to me again at 9:30 on Monday. On the Dow, similar story, huge uptrend, a couple of kahunas, mobile breakouts, weekly bongo green, got above this prior chandelier and PSAR resistance. Looks like it wants to go higher. If I look at the Russell 2000, all-time high, breakout, clean breakout, mobile breakout from a squeeze on the day before, new John Person buy signal, kahuna. And then if I look at the NASDAQ, similarly, we're going to see just a beautiful chart and a breakout above all prior intra or closing day. So ultimately, we're going to get pullbacks, and pullbacks could happen anytime, but we don't see any AD divergences. We don't see anything ugly on the four major indexes, and we have a low interest rate environment, and we have stimulus and federal funding coming. All those things are wind at the back if you're bullish, which could propel this market higher. Will we get pullbacks? Sure, we'll get pullbacks like we saw the prior week when I lost maybe $300,000, $200,000. We're going to get those kind of pullbacks. We've got them the whole way up. We've had pullbacks. But it's the reversals and running up towards new highs that have made the difference here. All right. Now, since you're following me, you're a growth person, let's look at the IBD 50 ETF. And it looks hopefully like your portfolio at new closing highs and ready to run. It's beautiful. How about the FANGs? As we saw before, the Canaries were close to new highs. The smaller group of FANGs themselves, the 3X ETN FNGU, all-time highs. If I look at semiconductors, Philadelphia Semiconductor Index, they've softened this week, so perhaps they'll run again. We've had some internal rotation. You look at whoops, did not want to do that. Sorry about that. If I look at biotech, biotech has also been on a tear. And if you look at biotech, you'll see some of those vaccines in the indexes, and you could see all-time high on the NASDAQ biotech index. So A lot of excitement in these indices. If we look at, say, the dollar, dollar is important if you're a gold bug. We had a gap down on Friday, finished down on the day. If you look at the week, you have a big bottoming tail. Now, notice how the price got lower in the person market catcher, the relative strength, comparing it to the S&P, kept getting stronger. So I'm not giving up on this dollar yet. So we'll see, and it had a similar pattern on the daily as well. You did get green weekly bongos on the dollar on the weekly, and that's another argument that it could still go higher from here. The dollar will influence gold. So let's take a look at gold and silver. So gold, it had a great day on Friday, but it's below its indexes. A lot of people are calling for gold to take off, and it makes all the sense in the world with the stimulus and the Fed and the deficit and the printing of money and the ultimate inflation, but it hasn't yet. One could argue you got similar lows here, yet look at the person market catcher showing a convergence of relative strength, bullish. So we'll wait and see what happens there. If we look at silver, silver got gamed by the sector bets crowd, who said they were going to try and make this the next GameStop. It's a little bit different on a commodity than a heavily shorted stock. And it ran up here, as you could see, on Monday. Of course, I got suckered into that, but I got out right away. And it stabilized here. Will it run? Who knows? I'm out of silver right now. Doesn't mean I'm right, just means I'm out. And gold miners look like gold. They have a ways to go. All right, so it's 40 minutes in. I guess you can tell that I'm bullish on the market. Bullish with I'm still afraid because it's run so far, but you got to trade the market we have. And right now, the market we have looks good. 07 on the market analysis user groups is industry groups. I hit the warehouse, it pulls up here. I've got 174 of them. If I look at the 2-day force, this would show me which groups are moving up with momentum. 93 are moving up with momentum. This is my top-down approach. If I look at 2-day force down, 4 are moving down. Interestingly, biotech was one of them. There must be a loser. Twist Biosciences was down 20% on Friday. Hope you didn't own that one. I don't even know what they do. If I look at the 5-day down, a more intermediate view, there's 28 groups to the downside. Oops, hold on, 4 groups to the downside. And if I look at 5-day up, it's 95. So clearly, the tenor of this market is bullish. Therefore, I'm going to look at the top groups that are bullish, and I would need more damage to pop up for me to think about going short this market. First group is application software. I right-click on that. Then I left-click, change to index group, and I list the stocks. So the first stock that I'm going to show you is one that I'll work up because I think this is one that might be a reasonable thing to be buying right here. Oh, stop that, will you? That's fine. Let me just... Every time I do these videos, I got to change my resolution. And when I change my resolution, I get problems like this. So Zoom video. Why do I like it? Well, we're in a bull market. Check one. We have the top industry group is application software. Check two. And I've got a strong uptrend, pull back to support. This blue line here is a 50-day moving average. And we broke out above the 50. A mobile breakout, a squeeze, a new John person buy here, and a kahuna. I can see that as even though we've got lower over here, even to the day we broke out, we have a positive convergence on the person market capture. When I look at the weekly, again, a pullback and a reversal. I think Zoom video looks good, and the only thing I don't like about it is that's a pretty big bar on Friday. It's a bar that's 7.5%. So even if I put my stop just below the bar, it's an 8% stop. That's wide stop, but it's not beyond the parameters that I'm willing to use. So we'll come back to Zoom. It's probably one of my favorites of the whole weekend. Earnings are not out to March 1st. Activision, I had a Bible gap up on Friday, so I probably wouldn't chase it. There are those of you that like trading Bible gap ups. This one made my week. I follow a lot of different things. I use a lot of tools. This stock, which I've been in since it was a teenager, kind of like SE, when I got in when it was a teenager. And why did I get in it here? Mobile breakout from a squeeze, a new person buy signal, a pocket pivot, and 2 kahunas in a row. This also makes the model book. It was making the model book for MarketSmith all the way back here. So I kept looking at that and finally got in. It's gotten a little bit loose, but what a run. Great earnings supplies. If you like me, you own it, I'd hold it. I certainly wouldn't be buying new stock at this price. I'd wait for a pullback. And I have options that expire on Friday. So I may actually start peeling them off or rolling them up and out because I want to keep this position. In fact, I may have already rolled them up and out. I'll have to go look. See, here it is. Da, 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 ba, ba, da, ba, da, da, da. You love it? I do. How often do you buy a stock as a teenager? Down in, it's even before that. I've been this thing for a while. Back here is when I got into the stock. And it runs from 15 to 200 and, 260. Someday I got to sell some of it, but, it has not violated this 50-day moving average. And when I say violated, I mean has not closed there and then closed a second time or traded below that prior close. That's what I usually look at to stop some of these big winners. Look at it on the weekly. I couldn't buy it here, but I'm glad I own it. BlackBerry, being paged by my dog once. BlackBerry, an old name, it got caught up in the Wall Street bets shorting fiasco. It's down. I mean, it was a great company, but I was skinny once too, and I'm not skinny. And I look at the falling earnings or falling revenue. I think they've got some decent software patents out there. Not my kind of stock. Next. And then I get to the index and I usually stop here. A lot of other really good stocks in this group, some of which you'll see soon on my buy watch list. What I did is I right-clicked and then I left-click, changed back to industry group. Second group down is internet media. Snap. I've never really been a Snapchatter. Maybe I should own Snap. Big run, great move on Friday, sort of a belt hold where it traded down, gap down, and ended up closing way up on the day. It's not at the high jump, but it's pretty extended. Google broke out on earnings. Not sure why it didn't count as a Bible gap up, but it's still holding the gap. Great earnings. I don't own much Google, at least not in my trading account. I wish I did. More Google. Baidu, based upon my type of buying signals, somewhere down in here where you had that pocket pivot kahuna coming out of a squeeze was a great opportunity. It's probably too late to own it now. Facebook, it feels like it's rolling over, trying hard to get back above the 50. Let it get back above the 50 before you chase it. Notice the weekly bongo is all red. Twitter, making another run, another company I never quite understood. Too far to buy. And you notice that's the story of today. The only ones that are not extended are ones that have had short-term pullbacks like the Zoom or things that are lagging like the Facebook is. And that's something you got to take into account. If things are not working this deep into this massive bull market, maybe you don't want to be owning them. Avanex, this is specialty pharma, a big run up to 30 and back down to 12. I don't know if they got caught up in the Cassava Biosciences story where Cassava had some data come out about Alzheimer's and it had a round trip, not quite coming back down to where it started, but it was a big mover that gave most of it up. Avanex, again, I don't touch stocks with this pattern. Let them base, and maybe I'll take it on the next run up if there's any reason for it. Great West Pharma, pot drug stock, which got bought out by Jazz Pharmaceuticals, so we can stop worrying about that one. This is one that I like the pattern. It has good seasonality right now. TG Therapeutics, 8 years on the market, 8 out of 8. It's up during the next 30 days. It's not about the earnings per share growth, but they did get a drug approved on Friday. Notice a big move up in anticipation, a pullback close to the 50, and you had a person buy signal, mobile breakout from a squeeze, a new person buy, pocket pivot, and a kahuna. I don't know how far I'd let it go against me before I got in, but if I could get it close to the 55 to 58 range, I'd probably take it this week. I think TG Therapeutics on its approval will start to change how it looks to Wall Street for the better. Here's another pot-related, I think they make lotions and ointments. Again, it probably ran up in sympathy to GW Pharma. I'm not interested. Again, in the market we've had with things at all-time highs, when you look at the charts of C and other stocks like it, why would we want to buy something that in the same market has just died? It's hard for me to buy laggards. Tilray, I do have a position here. It broke out back here, which is when I got interested. It's had a nice run up. Bible gap up on Wednesday and pretty much held it. I'll have a short leash on it. I got a pretty good position. I like it even more when I look over here at the weekly. Then we have another pot stock, Afria. And I think the pot stops is pretty obvious what's driving them. Right click, left click back, advertising and marketing. This is that MGNI I mentioned. So I had 30, 40 call spreads, and they went from being losers to big winners in about a week. I rolled one out before the big move up. So I've got some that are zombies that'll be worth $10 minus $8 on my $2 investment, and some that are still open. And you could see the move up it had. I didn't chase this too much because I don't know how much of this is just hype because of their acquisition, how much it's transformative. I have no idea. I don't know this space. I just know I had bought this stock. Why? Mobile breakout from a squeeze and the kahuna and a new John person buy signal. I buy all my stocks because of that pattern and or parts of that pattern. Write down the index so I don't go below. Internet-based services, number 5. Another stock I don't understand, Pinterest. I talked about it last week. I should have bought it. Broke out on, I think, on earnings. I had Bible gap up. All the same things I like. Mobile breakout from a squeeze. Kahuna coming off the 50. I just don't know enough about this company. Shopify, I'm in and out of all the time. It seems like it's starting to run again. Match Group, I don't need their services. Been married 35 years. Making a run off the 50. Mobile breakout from a squeeze. Breakout, person buy signal, 2 kahunas in a row. Technically, that's things I like to see. I look here, I see some big earnings per share growth. I don't think I like the company, but I might have to like the stock. Maybe if I was blinded to the name, I feel even better. FVRR, great stock, probably not the buy point. You need to buy it when it comes back to the 50. Notice how many times it comes back to the 50 and reverses. If you know that that's likely to happen again, why would you not wait until it comes back instead of chasing it? It doesn't make much money. Zillow, Uber's got earnings this week. Lyft has earnings. Coupa is another one that looks interesting here. Looks like it's starting to have a run. It's been very loose here, but it had a mobile breakout, a person buy signal, and some kahuna, so that's worth watching as well. Specialty chemicals. One of them made the list above the index. And again, it's a pattern I have a hard time buying. It looks like something happened. CPS Technologies. You can always right click, go to more info from web, finviz.com, and what will pop up here will tell you purchase order for hybrid tech armor panels for aircraft carrier. Okay. No idea. Maybe it's worth finding out, but that was a pretty, oh, come on. All right, pretty massive move here from 6 up to $28. Boy, I have a hard time chasing those things. Number 7, electrical power equipment. Blink, we've talked about this a lot. Probably at a good buy point. It's pulled back to the 17. I saw some recent upgrades. You don't know how far this thing can go, but building out electric charging is going to be an important thing in this country, and they're one of the folks in that field. Probably the best buy I ever gave you. Not the best, but I just think back to this day right here on a Sunday, I think. Thursday. Is this the day we was? No, it'd be over here. Somewhere in here. Yep, this is the Sunday. I talked about Generac here was at 95. The next day it gapped up, and those of you that were lucky enough to buy it have had a 150% return since the middle of May. Same pattern as I always trade: mobile breakout from a squeeze, new person buy signal, and kahunas. Consumer electronics. Don't know Microvision. It's been around for a while as a small stock. Something is going there. I don't know how much of this is related to the Wall Street bets phenomenon. 346% above the 200-day moving average. I can't buy that. It's way too expensive. Roku, talk about missing the boat. Here's what I let my brain get away from my strategy, because there are plenty of opportunities on the way up. Like right here, a Bible gap up, mobile breakout from a squeeze, a new John person buy signal, and a kahuna. I just never understood why people would pay so much for Roku stock when they make a box that I buy once, and then I load apps and I watch things on the app. They must get royalties on the apps, because I don't understand why people run them up so much. Group number 9 is commercial vehicles. Workhorse Group. I have a position in this. Great time to buy back here. New person buy signal off of the 50, and then a big breakout. They're waiting to see whether the post office, or when the post office puts out their request for proposals for their electric vehicle replacements, and they're supposedly, if not the leader, but one of the companies in the running for them. And if I remember correctly, they're Midwest based. Number 10 is Life Insurance Index, not my favorite group. Atlantic American, something big happened and stopped happening on Friday. How can you buy this stock? It opened at, let's see if I can get this right, 375. It traded to 1597 and closed at 520. It's a great day if you bought it in the morning and didn't look at it and just thought you made a ton of money. I would have to do a lot of research. Not my kind of stock. Lots of people interested in it. There's a lot of anomalies in the market right now because of, I think, the GameStop story. NetLife, uptrend, a little bit of a pullback off the 50, mobile breakout, person buy, couple pocket pivots, and a kahuna pays a 3.5% dividend. Not my kind of stock, but I can understand why people bought it. We talked a lot about precious metals and whether gold's going to go up. If you want to buy gold, my favorite gold was El Dorado Gold, which had pulled back and then had a Bible gap up on Friday. It's a cheap gold stock with really great numbers here. Look at the earnings per share growth on this stock. If it hits these numbers, you got to believe the stock's worth more than $13 a share. So I went through the top 10, actually went through number 11. I identified the challenge that I have with this market. By the way, this is an ugly chart. It's very loose. But, you look at Barrick Gold, you're buying a stock in a downtrend. You look at Newmont Mining, you're buying a stock in a downtrend. You look at AEM, maybe a little bit better, sort of going sideways at the 50. This one looks pretty good too. Mobile breakout from a squeeze, new person buy signal, Kahuna, and a positive convergence on the person buy signal. Let's go into my buy watch list. And it's up here. So these were the stocks that looked intriguing to me. I know some people will pause here and take a look at it. Actually, there's more than that because I cut off the first couple. Application software, we looked at Digital Turbine. 5.9 looked interesting to me as well, sitting here on the 50, mobile breakout from a squeeze. That one looked interesting. I didn't like the fundamentals as much. We'll come back to Zoom, Goodyear. Sort of a bottom fishing, then something happened on Friday. The auto industry is supposedly very strong. Their revenue looks great. I don't know, not that exciting, but I made a lot of money on them in the past coming off the bottom. On the biotech front, I think last week we talked about CGen, how it was a low jump where it had traded to the lowest amount of extension since the last year. Had a green candle low, I think. Let's go 1, 2, 3, 4, 5. Yep. I talked about it last week and said this one is at a place where I expect it to go higher. It had a great week. Boy, anybody took that trade, they should send me a present. I'm joking. I don't get paid. DraftKings has done very well. It's one of the stocks in the sports betting. I have DraftKings, but I also have some PENN. Look at that. Look at that puppy. I bought a crap load back here in this area. And I've sold off much of it. There's been a lot of buy opportunities on pullbacks. Still under demand. Great earnings per share growth. It's extended here. I'll probably take some profits on it this week. Hopefully I'll be in time. You want a cheap stock that looks like it's ready to roll. Fluidim, uptrend, sideways move, sitting on the 50. Mobile breakout from a squeeze. It's just got to clear this red line here, which is the chandelier stop. But I think that's one that's likely to go higher. An old name, I was surprised about this, Alliance Data Systems. Looks like it's starting to come off the bottom. This used to be a $250, $300 stock. Great earnings per share growth. The revenue came down some, under accumulation. Looks like it wants to go higher. It's got the mobile breakout from a squeeze, a person buys some kahunas. Another one that looked interesting, IPO, is CleanSpark. Pullback, a break above this chandelier stop will also flip the PSAR dot. It had a new person buy signal and a mobile breakout. That one looked interesting where it's sitting. Curiosity Stream, a very similar pattern, but looks like it broke out on Friday. Ulta Beauty, again, waiting to break out there. So clearly, despite the fact that it's a somewhat challenging to find stocks that are not way overextended and ready to run, I think I found you some. Let me just show you my pullbacks ready to run. That's usually the list that my best performers comes from. I basically build this list and then I build it again by individuals. Boy, a lot of them are, I'm going to go very quick. Very quick. Have no idea anything about Diginex. It's application software. Run up, pull back. You had a mobile breakout, broke out above the 17 with a person buy. It's an IPO. FedEx and UPS both have pulled back, and they've got rising person market catcher, mobile breakouts, person buy signal, two kahunas. This is FedEx. We know it's going to have great earnings because of all the packages shipped during COVID and during the holidays. 5.9 we looked at, Fluidin we looked at, Goodyear we looked at, JD.com. It's hard to buy a stock that's run like this. You want to buy it on pullbacks. It pulled back. It looks like it's breaking out, ready to run again. Great earnings per share growth. I mean, beyond great. JFrog is another IPO that looked interesting here. Notice the positive conversions on the person market catcher, and it's trying to break out down here. I wouldn't touch it till it cleared its PSAR dot, but that's one if you want to play with an IPO that looks interesting. Kinross Gold, another of these golds in a downtrend. At least this one had a mobile breakout from the squeeze. A person buy signal right at the 50 and a kahuna. Any move up will take out the 50. Kubient, don't know anything about them. Internet-based communication under demand. Pull back to the 50, mobile breakout from a squeeze. In a person buy, in a kahuna. That's the pattern I like. Lyondell Basel Industries. Old Dominion Freight. Party City, I don't know if it's truly a pullback, but it did pull back after that run out and it broke out on Friday. Mobile breakout from the squeeze. When I see two kahunas in a row, I pay attention. This is one who's changed its spots. It's gone from a downtrend to an uptrend, and it's got some earnings per share growth coming in. This is that week comparisons coming up. RPM, specialty chemicals, pull back here. It's really doing nothing except it's got some positive conversion on the market catcher, mobile breakout from the squeeze, a new person buy signal. Seagen I mentioned. Service Corps International stepping up. Looks like it's ready to run again. So there's a bunch of ore companies and copper companies that look interesting. Southern Copper, shallow pullback, still above the 50, off the 17-day, mobile breakout from a squeeze. A new person buy, pocket pivot and kahuna. This is the thing that usually runs for me. Great earnings per share growth, much bigger than the multiple. Spirit Realty, Starwood Property Trust, just took out its chandelier. Looks interesting. 9.4% dividend, that perhaps is the most interesting. Tandem Diabetes, one of my favorite plays of all time. I remember I gave this out back here at $5 stock. I still have it. It's now a $100 stock. It's in that same account as SE. It's sort of the funny account. I had 50,000 invested. It's worth 433,000 2 years later because I bought SE, Tandem, and Axosome, and I just leave them there. Someday I'll sell the Axosome. Tandem, major bullish convergence on the person market catcher, mobile breakout from a squeeze, breaking above the 200-day moving average. Person buy signal, pocket pivots, kahunas, all the things I like to see with some money coming in on the earnings. Talked about TG, Michaels, if you want to look at it, inexpensive retail, run up, pull back with mobile breakout from a squeeze. Expensive but high quality retail Tractor Supply. What I wanted to get to is, here's Valley, another ore company, pull back to the 50, mobile breakout. This one looks interesting. Come back to Zoom, and do I have, I'm playing FCX currently, so I'm not sure if I'm going to add to this type, but you could see what happened. It pulled back and then it broke out and is going to run again. So I said I'd end by working up Zoom. So let's take a look at Zoom and how I would play Zoom. So this is going to take a few minutes, but I'm going to try and make it worth your while. Okay, I'm going to put this right here for now. I want to buy Zoom. I am willing to risk $5,000. Okay. Let's take a look at Zoom here. Let's blow this up. All right. Now, up here on the top, I can bring this down, which is sort of corresponds to all the lines. So close was 419.59. The high was 420. So closed right below the high. Okay. The open, the low was 387.86. Let me pull out my iPhone while I'm sitting here. So if I take 419.59 and I subtract 387, is $31.73. If I divide that into 419.59, that's about 6.5%. So if I was to buy this, typically what I do is I look to the left, 1, 2, 3, 4, and I set my stop at the low of the lowest bar in 4. So that would be this bar here or this bar. So the low there is 379. The low here is 378. So one stop could be 378.51. So that's going to probably be approaching 7 or 85. Another argument could be made that I'm buying this because it's breaking off the 50, and it's breaking off the 50 with conviction. So the 50-day moving average is at 390.33. The low of this bar was 376.87. All right, I'm going to elect to put my stop $1 below the 50. So I'm going to use as a stop. So my buy stop, typically, there's lots of ways of how you might approach it. I put a buy stop in. And my buy stop says if the stock takes out the high of the day, so it's got to trade to 420.50. I don't want to buy it until it hits 420.50. Why? Because if I have an equal and opposite day tomorrow, why would I want to be in? If I have a down day, why would I want to be in? The worst is if it opens up, I get filled and it closes down, but I can't help myself on that one. So I would put a buy stop at 420.51. I'm going to put a sell stop at 390. I'm going to call it at 389.50. Reflecting a little bit below the 50-day. That means I'm risking 420.50 minus 389.50 equals, whoops, just do this in my head, shouldn't I? 420.50 minus 389.5 equals $31. And if I buy it at 420.50, is 7.3%. It's with -8, which is sort of my cutoff. So if I was to buy stock, I could buy my risk, which is 5,000, divided by how much am I risking per trade here? 31 equals 161 shares. My cost would be, if I filled at my buy stop 420.50, 67,700 0.50, and my risk which would be $5,000 is that 7.4%. Okay, so that's if I buy stock. That's not how I'm going to do this. When I look to enter a position, how do I enter positions? One, buy stock. Simple. Easy to put in stops, but ties up a lot of capital. Two, buy a call. Inexpensive? Maybe. Less capital? Yes. Can use stops? Yes. Time works against you, and need to pick strike and duration. You do a bull call spread, lower cost, but equals less risk, but you cap reward. 4, I can do a synthetic, same as stock, but cost almost nothing. I can do a Scott synthetic, which I'm going to show you. Same as synthetic with risk of a call. Or I could do a butterfly, or I could sell puts or put spread. That's the different ways I can play this. So let's take a look. I'm going to stop it and I'm going to bring up another program. Okay, so let me just lay out what I have here. As you can see, I put Zoom as a stock pick. This is a product called Options Pro on VectorVest. Tom Joseph, who did Advanced Get, I think it's called Dynamic Trend, is his company. He sells it as options analytics. The reason why I got it through VectorVest is the data is included at the similar price. So I put in there select spread type bullish, so a bunch of different bullish ways of trading. I'm looking at a March 19th, so that's a monthly expiration in March. I picked that as my duration. I decided to buy at the money, which is essentially $420. And then I looked at just one strikeout, so $10 difference. I could have gone 20, 30, 40. I mean, that's up to you as individuals. I probably in real life may have pushed it a little bit more, but for the example, I thought I'd show you this. So the easiest trade to take, let's see if that gets crazy big, is this trade. Now let me lay out what we're seeing here. The price that you paid, or the price of the stock when you bought it, is this dashed line that's going vertical. Down here is the stock price. As you would expect if you bought the stock, if the stock price goes up, you make money. If the stock price goes down, you lose money. And here's the amount of money gained or lost. It's equal in both directions. So buying the stock to control 100 shares. So we said we buy 160, but for every 100 shares, and this is one of the killers, to control 100 shares, it was going to cost $41,000, about $42,000. So big cash outlay. You have unlimited gains, you have unlimited risk, and one nice thing is you make money on $1 if it goes up, or you lose on $1 if it goes down. So buying the stock is perfectly fine. Just got to have a lot of money. What about if I buy a call? If I buy a call, here's the price, and this really reflects my P&L here. So why is this P&L different? So the first thing to show you is that you have to make money. You have to have the stock move enough to cover the cost of your call. And this call is $44, $45. So you're not going to break even until you get to this point of time where the price of the stock is trading above $445. Well, that's a bad thing about this. Plus, your strike price is $420. You have to get $420 plus $45. So you have to get to $465 until you break even. So your stock doesn't move. You lose your premium, which is $400. The advantage here is $43.50 to control 100 shares. The disadvantage is if it has to move $45 to turn positive, and the benefit of a call over the stock is all you can lose is that 43. Now we were willing to lose on this trade. What? We were willing to lose $31 times 161 shares, which is about $5,000. Here, even if it gapped against me and went down to 300 on earnings, all I could lose is the 43.50. So when I buy a call like this, I've already limited how much I can lose below my stop that I would have put on the stock. I like buying a call because I can control for a lot less money. I like buying a call because I've limited my downside. I don't like buying a call because this call is going to require me to move $45 before I make any money. That's tough. All right. I could buy a call spread. I don't know if I like this call spread, so let me make this 420, 440, make it a little bit more interesting. Okay, so in a call spread, first thing you'll notice is my cost is not $4,300 anymore, it's $875. The most I can lose when I buy a call spread is the amount of my spread. So why would I want to buy calls all day long and risk $4,300 when I could have bought a call spread with a much more modest risk? Well, the reason is simple. I capped my gains. Since I bought a spread that was 20 wide, the most I can make is $20. So minus my investment of, let's say, 875. So that means the most I can make is 1125. So 1125 on a 875 investment, that's over 100%. You can probably live on 100% trades day in, day out. So the benefit of a bull call spread is I've got fixed risk, my cost of the trade and my risk is much lower, but I've tapped out my gains, which, nothing's worse than buying a stock that's 420 with a 420, 450 call spread, and then the stock being bought out by $800. That's one of the downsides of a call spread rather. Now, one of my least favorite things to do is I'm going to do a put spread. In the put spread, I'm going to say, I know the stock is going up. So rather than me pay premium, why don't I sell somebody, in the case of this, I'm going to sell a put at the money for 420, and then I'll buy a protective put at 410. So I'm risking $10 on this trade, but I'm going to put in my pocket $545. So the most I can lose, maximum profit is $545 is what I make. My maximum risk is $455. So I could say, I know the stock's going to go up, so I'm going to sell a put spread. I've maxed out my loss at the difference between the two strike prices, and I've limited my cost because I'm buying and selling one, but all my gain is limited by the amount of premium I collect. Now, the beauty of this trade is, even if the stock loses money, I may actually be positive. Why? Because I've got a buffer of $545 that I put in my pocket. So I don't like this trade because it caps my gains. That's not such a bad trade when I look at it. Now, when I was young and crazy, I guess I'm still a little bit young and crazy, I would say, this is buying the stock, okay? And it's costing $41,959. Type that in. For 100 shares. And if the stock goes down, I lose money. If the stock goes up, I gain money. But I have to put out $41,959. Imagine if I told you there was a trade. Look at this trade. Same exact, unlimited upside, unlimited downside. You're profitable pretty much at the strike price, at the price you buy it. And your cost to get in this is your cost is $40. $40. So instead of paying for a synthetic, paying $41,959, I'm paying $40. Actually, that's for the synthetic. That would be to own the stock. And I'd pay $40 for 10 spreads of the synthetic. So let me tell you what I learned in the School of Hard Knocks. I saw this and I'd look at a stock like Apple, like Tesla. Man, this is great. I can control a lot for nothing. And I have the same risk as the stock. That is 100% correct. So what did I do in the early days of making mistakes? I would say, I'm going to buy 100 spreads. It's only going to cost me, 10 times 40 is $400. And if I buy 100 spreads, I'm going to control 1,000 shares, 10,000 shares, 10,000 shares. That's pretty awesome. It's not, because you're at risk for each one of those dollars when it goes down. So if you do synthetics, you have to realize it has the exact same risk as if you bought the stock, and don't overdo your position size. So let me show you the trade I do like. How about this trade? Yes, you're going to tell me, Jeff, it looks just like a call. And it does. It looks just like a call. I have unlimited upside. I have to have the stock go in my favor to break even, and I've capped my downside. But if I go back to that call, it cost me $43.50 to get in, and my maximum risk was $43.50. So I can create a synthetic call where it cost me $33.35 to get in. All right, that's great. But in exchange for saving $1,000 on the way in, which means I have less to move in my favor to be positive, I have a higher risk if it goes down. This is what I jokingly call a chicken shit synthetic, meaning it's a synthetic, but you're protecting your downside. Because that's a bad word, I now call it Scott synthetic, but what it really is a synthetic call. So what I'm really likely to do is to look at this and say, I like this. It's unlimited upside. What I might do is, how do I reduce my cost to play? I might look at this spread and say, let's add, so I'm going to sell March 19th, 480. Now, it turns out that $480, I don't want to put there, that's why it's so expensive. $480 call, because it's not going to be like that. I'm going to get, for selling a way out of the money call, I'm going to get 22 bucks. So now it looks like a covered call. All right, but it's only costing me $1,085. It's really wide with an upside of $49.15, which is almost 1.5 times my downside risk of $3,000. So now I've created a trade, and I'm just going to compare this to the covered call. So it is $200 more expensive to get in. And it carries a little bit more risk, much more risk, but I've got 3 times the profits on the covered call. And compared to the synthetic here, where's the synthetic? I've decided to cap my upside at $49.15, but I've really minimized my risk from $42,000, which is unlimited risk, to just $3,085. Why? Because I reduced the cost of getting in. So what trade would I take? Knowing how I trade, I would probably take this trade right here, where I would look at the March expiration, and I would buy a 420 call and sell a 420 put. And you could see from the pricing, they're going to negate themselves out pretty much. Then I'm going to buy a $400 put to protect it, to limit my downside. And I'm going to sell a 480 call. So the most I can make on this trade is the delta between the 420 call and the 480 call, which is 6,000, minus the $1,200 or so it's going to cost me to get in, $1,100 to get in. So I can make $49.15 per contract. And again, I could buy 10 or 20 contracts, and I could control enough Zoom to make me happy. How will I not be happy if Zoom goes to 600? But I'm designing the trade to make money. I don't really care about the ticker. And that's how I look at setting up the trade. So just to review, first thing I did is I looked at the stock. I'll set a buy stop above the high of the day, which means if it doesn't take out the high of the day, I'm not going to take the stop. And this is for education only. I set my stop below the low of the day. I didn't go back below the lowest 4 because 7.3% risk was more than enough for me. That means I'm risking, if I buy stock, $31 a share. So 161 shares, risking 5,000 if I get stopped out, and investing 67,700. Okay. Buying stock, I said simple, easy. Buying calls, inexpensive. Time works against you. Remember, you limit your risk. Call spread, you limit your gain, but you make it cheaper. The synthetic behaves just like the stock. I showed you how I combine a synthetic with a call, which reduces my risk of the short call. And then I could actually sell a call against that to reduce the cost. And I showed you the put spread is the only trade here that actually puts money in your pockets. And that's how I look at every trade. And one of the cool things is this program, and there's others that will do it too, I'm sure, and I'm not saying this is the only one by any means, allows me to list all these spreads and say, I like, from maximum profits, I really like infinity. Okay, I'm not interested in 565 profits and 565 risk. That's not my kind of trading, the ROI is incredible. So I'm going to look for an infinite return with a minimum downside risk. So this is how much money to get in, and the maximum risk is over here. So when I'm looking at this, the long call or the synthetics with the adding the put to it, or the protective put underneath, which I can't show here because it's not standard, how I like to take the trade. So on that note, I think I've talked enough. I'm losing my voice, and you probably are wondering if I'm ever going to shut up. Have a great week. Trade safe. We are getting extended by many metrics. I just feel this market's going higher. Trade safe, not often, and goodbye.